If I had to start over my experience, my portfolio, all of it, these are the only 4 ETFs that I'd buy to rebuild long-term wealth from scratch. My name is Ron DeLaw. I've been investing for over a decade, and I didn't start with money, nor did I come from it. I learned the hard way. I had to make the mistakes, and I figured things out along the way. And now I'm sharing these lessons with you in hopes that they help anyone avoid the mistakes that I had to learn firsthand. So why would you invest in an ETF in the first place? Since I'm starting over with investing, I need to understand the fundamentals. What exactly is an ETF and why should I put my money into one? I'm focusing on ETFs rather than individual stocks in this scenario, like an Apple or Nvidia, because when you're just beginning your investment journey, you want a solid foundation built on a higher probability of success. Think of it this way: instead of betting everything on a single company's performance, you're going to spread your investment across dozens or even hundreds of companies at once. This diversification significantly reduces your risk, because even if 1 or 2 of those companies performs bad, the overall basket of investments can still perform well. An ETF is simply an exchange traded fund. It's a basket of investments or companies packaged into a single stock that you can buy. It's perfect for beginners who want results without that complexity of researching these individual companies, analyzing their quarterly return reports, and constantly looking at charts and monitoring the market movements. When you buy one share of an ETF, you're instantly getting exposure to all the companies that it holds, which means you're automatically diversified from day one. So I'll try to make this analogy and let's see if this makes any sense. So instead of putting all your eggs in one basket, like Apple in this example, you would invest in a basket filled with the best eggs. Focus on the basket, not just one egg. So we are not putting all our eggs in one basket. Instead, we put all the best eggs, or companies in this case, in one basket and then invest in the basket, not the egg. You've probably heard of the S&P 500, which tracks 500 of the top companies in the United States. Giants like Apple, Microsoft, Amazon, hundreds of others across every major industry. The beauty of ETFs is that you can invest funds that track these major indexes like that S&P 500, giving you ownership to all of the 500 companies in one single purchase. This approach has historically delivered solid returns over the long term, while requiring minimal effort from you as an investor. As you invest more and build that habit and become a smarter investor, you can then take more risk and look at individual stocks. But we're just starting over in this scenario, so ETFs are the way to go. Quick disclaimer, none of this is financial advice. I'm just a guy on YouTube with the mic. So always do your own research before investing. And this video took a ton of work to put together, so if you find any value whatsoever, please do me a favor, hit that like button. It helps me more than you know. There are thousands of ETFs to choose from, and to be honest, a lot of them have significant overlap when it comes to the companies that's being held. You might find Apple, Microsoft, Amazon showing up across multiple ETFs in your portfolio, and that's okay as long as it's weighted differently and holds other companies that the other ETFs may not hold. That's why it's important to look beyond just the ETF's name and examine a few factors: the actual companies within the ETF, historical annual returns, and something called an expense ratio. When I was creating this ETF list, I wanted ETFs that have historically delivered strong average annual returns while keeping the costs low with minimal expense ratios, because even these small fees compound over time and they can eat away at the returns over the course of decades. An expense ratio is an annual fee that fund charges to manage your investment, expressed as a percentage of your total investment. For example, a 0.05 expense ratio means that you pay just $5 per year for every $10,000 you invest. The lower this number, the more your money stays invested and working for you rather than going towards management fees. I spent a lot of time putting this list together, and my goal was for it to check a few important boxes. I wanted it to be safe, proven ETFs, but I also didn't want to be overly conservative. I still wanted some growth, exposure to innovation, and the ability to benefit if markets perform well over the long term. So this is a balanced approach: protection on one side, opportunity on the other. With that in mind, here's what I came up with. First, let's take a look at VUG. Vanguard Growth Index Fund ETF shares. VUG tracks the CRSP US Large Cap Growth Index, giving you broad exposure to large US growth companies across all sectors, including tech, healthcare, consumer, and more. I chose this ETF because I wanted exposure to more growth and innovation stocks that perform well during the bull market. Some of the holdings, as you can see, in VUG are Nvidia, Apple, Microsoft, Google, and Tesla. Vanguard Growth Index Fund ETF shares is included in this list to give us exposure to large US companies that are expected to grow faster than the overall market. What makes VUG a good option for an ETF to invest in is it strikes a balance between growth and stability. These aren't like speculative startups. They're profitable, dominant businesses with strong balance sheets. VUG also comes with very low fees, which means more of your money stays invested and compounds over time. It has an expense ratio of only 0.04%, which is the annual fee the ETF charges to manage that fund. So let's say that we invested $10,000 at 0.04% of $10,000, that's only $4 per year. The beauty of a fund like VUG is that the fee is almost negligible. So most of your returns stay invested and compound over time. If we look at the annual returns, we can see that it performs very well most years, but is volatile as well, as you can see here in 2008 and in 2022. In a portfolio, VUG works well as a growth engine. It adds a higher upside potential compared to the total market or value-focused ETF, while still being grounded in high-quality companies. That's why, if I were starting over, VUG would be one of those core holdings in my long-term growth portfolio. Before I say the next ETF on this list, I know there's overlap in some of the companies, but I'll explain why it's included for me, and that's QQQM. QQQM is also known as Invesco NASDAQ 100 ETF. It tracks the NASDAQ 100 index, which is heavily weighted toward technology, innovation, and growth-driven companies. Unlike some of the broader market ETFs, QQQM focuses specifically on large, non-financial companies listed on NASDAQ, which means it's more concentrated and more growth-oriented. Yes, there's some overlap between QQQM and VUG, but they serve different purposes. In my portfolio, QQQM is my concentrated growth bet on tech, AI, and innovation, while VUG provides diversified growth exposure across sectors. Together, they create a balance between higher upside potential and broader stability. You can also invest in QQQ, which tracks the same index. The main difference is the cost. QQQM has a slightly lower expense ratio at 0.15% compared to 0.18% for QQQ. Performance is essentially the same, so you really can't go wrong with either. I prefer QQQM simply because of the lower fee. Historically, returns from these ETFs have been very strong, but it's important to understand that it's more volatile than some of these other ETFs that we'll look at next. That said, for long-term investors, the growth potential, in my opinion, makes the volatility worth it. Next, we have SCHD. SCHD, the Schwab US Dividend Equity ETF, is a great dividend-paying ETF for low-risk exposure to large US companies that pay reliable dividends. It focuses on roughly 100 high-quality, dividend-paying stocks with strong fundamentals and long histories of consistent payouts, which helps provide some steady passive income without taking on the volatility of those more growth-oriented funds like the VUG or the QQQM, which we also hold. SCHD's expense ratio is also very, very low at 0.06%, meaning, again, that you keep most of your returns instead of paying them in fees. That equates to only about 60 cents for every $1,000 that you have invested per year, which is another reason why a lot of long-term investors like it. Its dividend yield typically sits around 3.5% to 4%, give or take, and is pretty much higher than most of the broader market average, making it attractive to income-focused strategies like retirement income or dividend-focused portfolios. Because it's a broad, diversified ETF of large, financially stable companies, SCHD tends to show moderate volatility with relatively smoother performance, which is nice alongside the other two more volatile and growth-focused ETFs that we have on our list. And this is a great ETF if you want income with lower risk, which is why I like SCHD. Next, we have VOO. VOO is Vanguard S&P 500 ETF, a fund that tracks the performance of the S&P 500 index, which represents 500 largest publicly traded companies in the United States. You're buying a tiny piece of America's biggest, most influential companies all at once. So your money is spread across tech giants, consumer staples, healthcare leaders, and more rather than concentrated in just a few stocks. With a super low expense ratio, I think the lowest on this list at 0.03%, it's a favorite for long-term investors who want steady market returns and compounding growth. This is one that I hold for decades. This is the one ETF that truly creates a solid foundation in the investment portfolio. Historically, the S&P 500 has been one of the most reliable wealth building tools ever created, especially if you stay consistent and keep investing through the market's ups and downs. Its annualized 10-year return CAGR, I think that's how you say it, CAGR, which stands for compound annual growth rate. It's a way to measure how the investment grows on average per year over a period of time, assuming the gains are compounded or reinvested each year. And for VOO, that's roughly 14 to 15% per year. VOO isn't about timing the market or picking winners. It's about owning the market, letting compounding do the work, and giving yourself a simple, stress-free to grow wealth over the long run. So when you ask me if I had to start over and only choose between 4 ETFs, this is exactly how I do it. 4 ETFs, a simple plan, and a foundation built to last. VUG for growth and innovation, QQQM for the tech and AI future, SCHD for reliable income and stability, and VOO, the ultimate backbone of any portfolio, owning a slice of America's biggest companies, compounding quietly over decades. These core holdings are about building a portfolio that works while you live your life. That's the beauty of ETFs. They take the guesswork, the stress, the endless scrolling through news headlines and stock charts, and they replace it with something simple, powerful, and proven over time, which works out well for most people. 10 years from now, 20 years from now, you're not staring at an individual stock wondering if Apple or Tesla will bounce back from this quarter. You're sitting back, drinking your coffee or whatever you drink, and watching your balance grow. Every dividend being reinvested, every growth company compounding, your money quietly working while you sleep, while you focus on your family, your career, and your life and making more money. Now, I won't pretend that this is all easy. You will see ups and downs, and the market will test your patience, your nerves, and your conviction. But the beauty of these 4 ETFs is that you don't have to predict the market to win in the long run. You don't have to pick the next big tech stock or time the next crash. You just stay consistent, stay disciplined, and let time and compounding do the work. And that's the lesson that I learned the hard way. I made every single mistake possible in my early years, chasing hype, over concentrating on single stocks, letting emotions make my decisions. But if I had this strategy back then, I would be much further along today versus investing in a single stock. And then after this, investing in single stocks and doing some active trading with options can be extra on top of a already well-balanced portfolio that you have already created. So here's my challenge to you. Take this, adapt it, make it yours. If you only have one of these, then focus on that. Study these ETFs and understand why they work. Build your own basket of eggs and then let it grow. Because wealth isn't built in a day, it's built over a decade, over a lifetime, with consistency, patience, and smart choices. If you are still watching, please drop a fire emoji in the comments. Let me see you. Hit that like button if this video helped you in any way, and subscribe to this incredibly tiny channel, and take that first step today toward the portfolio that could change your financial future. Because starting over doesn't mean you're starting from scratch. It means you're starting smart. It means that you're starting with the right foundation, with ETFs that work as hard as you do. And if I had to do it all again, these are the 4 ETFs of where I would begin. Check out this video next, and thank you so much for watching.